If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Ghana's economy faces a perfect storm in 2025. Soaring debt levels and crushing interest rates are strangling growth. With interest rates hitting 28%, businesses are drowning. But the numbers tell a more complex story. Let's dive into the data that reveals Ghana's economic reality. 5 critical factors are reshaping Ghana's economic landscape. First, historically high interest rates reached 28% in early 2025. Second, public debt levels remain elevated despite recent improvements. Third, inflation soared above 20%, forcing aggressive monetary tightening. Fourth, unemployment pressures persist as credit tightens across sectors. Yet remarkably, GDP growth accelerated to 5.7% in 2024. This creates a paradox of growth amid financial constraints. Understanding this contradiction requires examining the underlying data. The second quarter of 2025 marks a critical inflection point. Let's analyze exactly what the numbers reveal. Ghana's GDP annual growth rate tells a recovery story. Full year 2024 reached 5.7%, nearly doubling 2023's performance. Q1 2025 maintained momentum at 5.3% year-on-year. However, forecast project moderation toward 4% for full year 2025. Q4 2024 showed modest quarterly expansion of 0.9%. The interest rate story dominated Ghana's economic narrative. Early 2025 saw rates hike to 28%, the first increase since mid-2023. This hawkish stance aimed to combat persistent inflation pressures. By mid-2025, rates were cut to 25% in the largest single reduction in central bank history. Despite the cut, rates remained extraordinarily high by global standards. High borrowing costs imposed heavy burdens on private sector credit. Many businesses and consumers found credit prohibitively expensive. Labor markets remained under pressure with vulnerable sectors experiencing constrained job creation. Tightening credit conditions typically slow business expansion and limit employment improvements. The investment climate reflected these challenging borrowing conditions. Consumer inflation dominated early 2025 with readings above 20%. This elevation prompted the aggressive monetary tightening we observed. Mid-2025 witnessed rapid disinflation, with inflation falling toward the mid-teens. This reached the lowest levels since late 2021, supporting rate cuts. However, inflation remained well above comfort levels, justifying continued vigilance. Public debt defined Ghana's macroeconomic landscape throughout this period. The 2024 debt-to-GDP ratio of 61.8% reflected legacy fiscal accumulation. By Q1 2025, the ratio improved modestly to around 55%. Mid-2025 reports cited debt declining dramatically to 43.8% of GDP. Substantial debt restructuring and successful bond negotiations underpinned this improvement. Support from multilateral institutions provided crucial policy space. Fiscal consolidation efforts contributed to improved debt sustainability. Year-end 2025 forecasts project debt to GDP below 60%. This improvement offers valuable policy space for fiscal and monetary easing. These interconnected trends reveal a complex economic balancing act. Case Study 1. The Bank of Ghana's dramatic policy pivot illustrates the delicate balance between inflation control and growth support. The sequence from aggressive tightening to historic easing within months demonstrates responsive central banking. The strategy proved effective, with inflation falling from above 20% to mid-teens, validating the aggressive approach. Compared to peer emerging markets, Ghana's rate levels remained extreme, reflecting unique inflationary pressures. Case Study 2. Ghana's debt restructuring represents one of Africa's most successful sovereign debt workouts in recent years. Successful negotiations on external bonds enabled Ghana to exit default status while maintaining creditor relationships. The restructuring dramatically improved debt sustainability metrics, creating space for economic recovery. Market confidence improved significantly, as evidenced by declining risk premiums and renewed investor interest. Case Study 3. Ghana achieved robust growth despite financial constraints, illustrating economic resilience. Key sectors maintained expansion even under high interest rate conditions, supporting overall GDP performance. The growth composition reveals how domestic demand and investment adapted to challenging credit conditions. This resilience stems from diversified economic activity and adaptive business strategies. The labor market story shows how employment patterns adapted to the high interest rate environment. Ghana's substantial informal sector provided employment cushioning during credit tightening periods. Workers and businesses demonstrated adaptability, shifting strategies to navigate challenging conditions. Regional variations in economic performance reveal how different areas coped with macroeconomic pressures. The interplay between high interest rates, improving inflation, continued growth, and debt reduction defines Ghana's Q2 economic narrative. Policymakers faced classic trade-offs: controlling inflation versus supporting growth, reducing debt while maintaining investment. The timing of policy adjustments proved crucial, with rate cuts following successful inflation reduction. Economic feedback loops created both virtuous and vicious cycles throughout this period. Beyond cyclical factors, Ghana's economy showed signs of structural adaptation and modernization. Institutional strengthening, particularly in debt management and monetary policy, enhanced economic resilience. Productivity improvements in key sectors helped sustain growth despite challenging financial conditions. Enhanced competitiveness emerged from forced efficiency improvements during the high-cost credit period. Looking ahead, Ghana's economic trajectory depends on maintaining this delicate balance between stability and growth. Key risks include external shocks, commodity price volatility, and the challenge of sustaining fiscal discipline. Opportunities arise from improved debt sustainability, enhanced institutional credibility, and demonstrated resilience. The policy space created through successful stabilization provides options for supporting long-term development goals. Ghana's Q2 2025 economic story demonstrates how sound policy can navigate between competing pressures of debt, inflation, and growth. The experience offers valuable lessons about monetary policy timing, debt restructuring, and maintaining growth during stabilization. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.